Hello, everyone. I'm Lou Kerner, and welcome to Stablecoins Are Killing It, episode number 26. I'm with Blockchain Co-Investors, and we've got a great show for you today, featuring Hong Kong-based Sudhu Arumugam. Welcome, Sudhu.
Thanks, Lou.
And he's with CoinFLEX and the Flex USD stablecoin. And we have US-based Ben Simon with Mechanism Capital, and Ben was the author of an epic stablecoin treatise titled "Stability, Elasticity, and Reflexivity: A Deep Dive into Stablecoins." And after, I thought it was super insightful, and I reached out to Ben, and I'm excited to have him on the show to talk about what he's up to in the industry and to dive into his space. Welcome, Ben.
Thanks for having me, Lou.
So Ben and Sudhu will each walk through a presentation for about 10 minutes, and then we'll open it up to questions from the audience. If you have a question, put it in the chat. If we pick your question, we'll bring you up on stage so you can interact with Ben and Sudhu yourselves and ask questions. It's very informal, but we should have a great show today, and I'm excited to start it off with Sudhu. So I'm going to make you the host so that you can share your slides.
Sure, I didn't bring any slides, but I'm happy to talk off the cuff.
Terrific. Then you can just start talking off the cuff and I will stop my share. So there you go. So now
perfect. Thanks for having me, Lou. Yeah, so I'll give you a bit of background about CoinFLEX and then how that leads into Flex USD for your viewers. So CoinFLEX is the first physically delivered crypto exchange. We launched about 2 years ago, and in crypto, we're kind of we first launched physical futures backed, which is a subsidiary of ICE, launched about 6 months after us in the US. So we're kind of the offshore version, ICE are the onshore version. And we are big believers in physical delivery because we know that from the traditional space that physical delivery allows a mechanism for to prevent against market manipulation, because large firms, large investors, if there's any sort of shenanigans in the underlying product, physical delivery ensures that derivative contracts stay very, very close to the spot contract. And now, about 6 months ago, we launched a repo market in crypto. And what is a repo market? Essentially, a repo market allows short-term lenders and borrowers of dollars and coins to interact with each other through a central order book. And we launched our Earn product at the same time, and the Earn product essentially sat in repo and took advantage of basis. And some of your viewers might be wondering what basis is, and basis is a very, very simple thing. It's the difference between futures and spot. And in crypto, when you get retail leverage long buyers kind of coming in to buy futures on leverage, they tend to drive futures markets above spot markets. And that gap is traditionally taken, that the advantage of that gap is traditionally taken by trading firms around the world. And that dollar difference essentially translates to a synthetic interest rate. And so we launched the repo product, and there was some good retail interest in this repo through the Earn bot. And some of our users suddenly realized and mentioned to us that why don't we tokenize that product and make it into a stable coin? And we kind of designed a product called Flex USD. And Flex USD is essentially a stable coin. You send in USDC, we tokenize it and give you Flex USD. And it basically takes advantage of this difference between futures and spot and pays interest 3 times a day on chain. And why would you ask, does this gap exist in the first place other than leverage buyers? Essentially, it's because we have at one end of the spectrum, we have $32 billion of stable coins earning 0% at the base layer. And at the other end of the spectrum, you have about $18 billion of derivatives OI that pays anywhere between 10 to 30% annualized on funding. And why does Perps pay that and that gap? And the reason being that basically, if you go to a lot of cash settled exchanges, the only mechanism that they have, because they're cash settled, to keep the perpetual future very, very close to spot is to charge longs and shorts. And because perpetuals tend to trade above the spot market, if you're a long perp holder, you tend to pay a lot of funding in fees. And so Flex USD essentially captures that gap, the 0% that you earn on stablecoins versus the derivatives contracts that earn 10 to 30%. And so in any 8-hour period, if you look at the kind of returns you can get from Flex USD, you get anywhere from 5 to 25%. And this is very, very natural interest rate that exists in the market. There are no sort of token drops or airdrops that exist in DeFi or in other CeFi mechanisms. And whilst we can't guarantee what the rate is because it depends on market conditions, this gap between 0 and 30 or 0 and 50 comes naturally from the market. And this is not just something that crypto sees. This also happens in the traditional markets. You see this in oil, corn, other agricultural contracts. And we are very, very confident that this will be seen for a lifetime yet, because it's existed long before we've been around. Now, some of the uses of Flex USD are very, very interesting because we give you the tokenized coin. You could keep it back in your cold wallet and still earn interest 3 times a day. You could use it on CoinFLEX and other exchanges when they adopt it, to use it as collateral to trade derivatives. And the most exciting of all, and this is where we're starting to look at DeFi, is where we think that Flex USD should become the dominant stablecoin in DeFi. And why do we say that? We know that stablecoins form a huge part of yield farming. We also know that when people send in USDC to Curve or Aave or any of the other big protocols, they earn essentially the USDC that's put into those pools earn nothing from the USD component. They obviously earn yields from airdrops, from AMM fees and other kind of pool incentives, but the USDC deposit itself earns you nothing. Whereas with Flex USD, if you deposit USDC with us, tokenize it to Flex USDC and put it into the Curve pool or Aave pool or Metastable pool, you will basically earn interest into the pool 3 times a day. And so we're very, very excited about making this journey into DeFi, which we'll be announcing some pretty interesting projects on that in the next couple of weeks.
And can you talk about where you are in terms of rollout and such?
Yeah, so Flex USD was launched about 3 weeks ago. We have over $30 million minted on it. It's an ERC20 coin as well as a BCH SLP coin. We are blockchain agnostic. We'll be rolling it across all the blockchains eventually, and we're looking forward to that.
And obviously, my experience has always been that you have no idea what's going to happen. You can plan it out, and you can talk to people, but until you go live, you have no idea. So, what have you learned in the 3 weeks?
We've learned that basically people are absolutely amazed that there is a stable coin which they do absolutely nothing with, and it pays them interest. And so we've had a bunch of retail interest coming into minting Flex USD. I think the real eye opener is going to be when we get invited by these communities on the DeFi side to participate in their projects, because that's going to really, really open the eyes to kind of passive dollar lenders who essentially rely on, right now, rely on airdrops in a lot of these pools to earn yield. Whereas here, even when the token airdrops finish in a year's time or 2 years' time, and we will still end up earning yield.
And what's interesting, it's such a small industry. I mean, it's growing like that. It's crazy. But generally, most projects have gotten some inspiration from existing projects. Can you talk about who you got inspiration from and who you learned from and maybe took some elements of?
Yeah, sure. I mean, if it's, it was really DeFi, and we were eternally grateful for DeFi because we're a CeFi exchange. And when we launched the Earn product in repo, we were kind of pretty excited because essentially it did the same thing. It would kind of capture this basis. But the DeFi craze of the summer essentially showed us that there was this whole other world of yield farming. And to yield farm, there's no point having your own individual Earn product on CeFi. You had to tokenize your own product suite. And so literally, if it wasn't for the craze of July, August in DeFi, we would never even come up with the idea that we could tokenize our Earn product into a stable coin. And this is where Mechanism and these guys have, been real pioneers in kind of growing this space. And, Andrew and his colleagues. Yeah.
And so as you look out in 2021, kind of what's next, and where do you think you'll be by year end?
On the stablecoin side, we're seeing exponential growth on stablecoins, especially because as real world dollar interest remains near zero or negative if you go into government bonds, US dollar stablecoins are just yielding higher and higher rates. And I don't know whether you guys really appreciate it in the US, but if you look outside the US to Asia and Europe, it is extremely expensive and difficult to borrow dollars. And this is where stablecoins are providing a really a fast route to move money around, number one. And number two, dollar yields on stablecoins are absolutely sky high. And for example, if you wanted to contact any big borrow lend desk and ask them to borrow USDC tonight or USDT, most likely they'll quote you somewhere between 12 to 14%. Whereas obviously, as we all know, the Fed is printing out dollars at 0% onshore. And so there's this huge kind of demand for stablecoins, and there are two basic sources of demands. One is trading firms who need USDC, USDT to trade on dollar margined exchanges like ourselves, and there's of course the whole stablecoin boom as well for farming.
Cool. Well, thanks a lot, and thanks for sticking around while Ben does his talk and for the Q&A. But the last thing, and I should have asked this at the start, how is it that you ended up in Hong Kong?
Yeah, so we were kind of trying to find a city in the world that would fit our kind of derivatives background and derivatives business in crypto. And Hong Kong has been traditionally very welcoming to crypto derivative exchanges. And there are a bunch of us who are based out of Hong Kong, from BitMEX to exchanges such as that, and OKX and Huobi and FTX and ourselves, CoinFLEX. So it was a natural home for us because it's the nearest point to China that we can be without being in China. And so we sit between the Eastern and Western flows of crypto.
Yeah, well, I guess maybe you're a little closer to China today than you thought you might be.
Absolutely, yeah.
Okay, thanks for sticking around. And with that, I'm going to pass it over to you, Ben. But it would be great, too, if you could talk about your background before you joined Mechanism Capital.
Of course, yeah. Well, thanks again, Sudhu. That was a great presentation, first of all, and thanks, Lou, so much for having me. So first, yeah, I'll talk a little bit about my background, then I'll go into just maybe a deep dive, maybe a little bit more quickly, and try to pack in as much information as I can about algorithmic stablecoins, including some of the things I didn't even talk about in my article. So yeah, who am I? What's my background? So I'm currently, as you said, on leave from Harvard. I would not consider myself a dropout, but it's unclear when I'm going to go back at this point. Possibly next year. I'm not sure. But I study a mix.
Let me ask the question.
Sure.
Is Mark Zuckerberg a dropout, or do you think he's going back?
I think he's probably pretty fairly say he's a dropout, but I don't know how happy my mom would be about me dropping out. Also, I think at some point, there might be graduate studies in the future. So for myself, so that might be a good reason to finish my degree. But yeah, so I'm currently at Harvard. I study a mix of things. I've focused more recently on the humanities, but I came into school focusing on economics and thought that I'd be an econ major. Actually, I've been interested in cryptocurrency since late 2016, early 2017. Even joined a startup that was founded by a friend of mine who's now a classmate of mine at Harvard. That was more in the data security blockchain space, not exactly crypto, but using some similar sort of threshold cryptography algorithms that we see also being used by crypto companies and protocols. But so I've been interested in it for a while. I've been very interested in economics for a while. I think actually what I found in college is that economics is very dry. It became more about multivariable calculus and sort of advanced sort of mathematics without exactly the real world implications. And so I've actually, my love of economics has sort of dwindled a little bit, at least academic economics. And that's something that I've actually rediscovered, I think, this year, especially going full time into crypto. A lot of the sort of game theory and incentive design and sort of thinking very deeply about economic factors and cycles and trends and how all these things fit together. That's something that you don't necessarily get to do in academic economics classes, but it's something that you get to do all the time in crypto. So,
and I'm sorry, where did you where did you grow up before you went to Harvard?
in Boston. So it's close to home. And yeah, so I went full time into crypto about 7 months ago. And I've, for the longest time, I've actually been interested in Bitcoin, but had always been a little bit skeptical of ICOs and some of the other products that were being built on Ethereum. And it was really discovering DeFi late in sort of the late spring, right before this massive DeFi summer, as Sudhu talked about, that piqued my interest for the first time in sort of this massive crypto area outside of Bitcoin.
How did you originally get introduced to Bitcoin?
So I was originally introduced to Bitcoin by my friend who's my classmate at Harvard, who told me about it in 2016, 2017, before that first massive run up. And I had actually been exposed to sort of Austrian economics in high school through some summer programs, and I had a very, very strong libertarian streak in me. And so the political aspect of Bitcoin, and that's somewhat still remains. Maybe it's, I think, been tempered a bit over the years, but that definitely appealed to me. This sort of hard money, digital gold narrative at the outset, and so that's something that stuck with me. And I've kept tabs on Bitcoin even over the years after the bull market, but really only this year dove into it full time, and then discovered DeFi, and something really clicked when I sort of realized that you have this permissionless decentralized currency that has a hard cap. It's this digital gold, but if it just plugs into traditional financial infrastructure, it can do a lot of good, but the system isn't just, I mean, we need a lot more than just, I think, a currency that can be good. And I think stablecoins are extremely important, and something that obviously I'll get into. So this is probably when I should probably start transitioning to the sort of discussion.
Okay, perfect. So you can share your screen if you've got a presentation to share.
I plan to I outlined a little bit of things that I wanted to talk about, but I was also going to talk off the cuff. I can briefly explain what I want to talk about today. So I want to talk about first what algorithmic stablecoins are. I then want to talk about a little bit why we need them and how they compare to other stablecoins. I'll get into a little bit of the benefits and drawbacks and some of the current designs. And then I want to talk about maybe what I see as the future of algorithmic stablecoins, where we're heading now, and how some of the problems that I think currently exist with algorithmic stablecoins might be remedied going forward. So
okay, thanks. And Sudhu, you should feel comfortable if while Ben is talking, you have a question about what he's talking about or want him to expand on something, feel comfortable to ask a question as well.
And certainly stop me if I'm either sort of going too fast or if there's any clarification questions. But yeah, so let's start briefly with what algorithmic stablecoins are at a very high level. I'd say if you made me tell you
and again, Ben, as we talked about, the audience here is very sophisticated.
Sure, of course.
So yeah. So
I won't go too sort of basic, but I want to frame it as at a high level first to start. And so I'd say algorithmic stablecoin, unlike these other stablecoins that exist, is something that I would say is a token that basically expands its supply when it's trading above a certain target price and contracts it when trading below a certain price. That's, I think, the maybe highest level definition. Now, there are various reasons why we'd want one. And various sort of approaches to getting to this design of an algorithmic deterministic token that doesn't have a hard peg the way that, for example, USDC might have a hard peg because it's minted against the dollar. And so some of the sort of easier sort of more narrow ways of approaching that question is, well, looking at some of the design flaws of other forms of stablecoins. So for example, I would say there's two other main categories, and I talked about this a little bit in the article, so I won't belabor this point, but there's sort of centralized permission stablecoins like USDC and USDT that are minted and basically controlled by centralized parties like Tether and Circle. Those aren't over collateralized, but they involve a lot of trust on the part of the user that these centralized minting institutions and I guess you'd call them custodians, that they're actually going to follow through on providing backing for whatever USDT that you have. And there's obviously a lot of questions now, and there have always been questions circulating specifically with regard to Tether. So that's one potential problem with those kinds of stablecoins. Then there's also decentralized permissionless stablecoins like DAI, SUSD, reserve rights, and there's a whole host of others. those for the most part tend to be over collateralized. And so the user can mint those permissionlessly, meaning anyone can go into MakerDAO's system and basically put down a given amount of collateral and mint a DAI based on the Oracle price of US dollar. But to do that, you have to put down sort of more collateral than you want to mint DAI. And so it's basically capital inefficient in that sense. And there's other problems, there's other benefits, and I don't want to dwell on those too much. But what algorithmic stablecoins open up is essentially this token that doesn't trade with this hard peg the way that these other two kinds do. There's no minting and redeeming mechanism except for Frax, actually, that I'll get into, which is as like a sort of sneak peek, is actually one of my favorite designs currently that exists on the market. But in the pure algorithm,
have you had a chance to interact with? Have you had a chance to interact with Sam? He's been a guest. He was a guest on one of the very first shows we had.
Yeah, so I have interacted closely. I've spoken with him a lot individually about Frax, and he's working very hard to improve the design. I think there are even some ways it can be continue to be improved. But I've been in touch with him for a little while now. Yeah, so I'm a fan of his, and I'm happy to get more into Frax in a sec. But just sort of, I think there's sort of a nice narrative in terms of how to understand algorithmic stablecoins and sort of the development of algorithmic stablecoins. And, a lot of this I've already written about in my article. And so I don't want to, but to start, there's like this most simple model of algorithmic stablecoin, which is basically what exists in the current form of Ampleforth, even though Fernando Amatrano, who is this academic crypto expert, originally wrote a paper about this, I think 4 or 6 years ago. But this is a token that essentially, as I just said, expands its entire supply when it trades above $1 and then contracts below $1. And the way that these new tokens that are created are distributed is basically across the entire network of Ampleforth holders. So if Sudhu, you own 10 amples before supply expansion, and the Ampleforth token is trading at above $1. Let's say it's trading at $1.10, and the token, let's say the supply expands by X amount, let's say by 10%. Then after you originally hold 10 amples, then you're going to then hold 11 after the expansion. Let's say I hold 1 million, then I'm going to hold 1.1 million. So it's sort of this.
Ampleforth has also been a guest on the show, and I'm a big fan. But do you consider it a stable coin?
Yeah, so this is a good question, and this is something that I think there's been a lot of debate about. So if you were to ask first of all, I consider, here's the answer I would give. If you were to ask Ampleforth proponents and the founders and people who are active in the community, there have been a lot of talk about how Ampleforth is actually not a stable coin. It's actually a sort of uncorrelated base money. Now, I think this is potentially a little bit misleading because it has this algorithmic stability built in. It has a price target that it's intending to sort of converge upon from either higher or from lower. And I think, even if it were to be shown that it is uncorrelated, and so far it has been uncorrelated at least in price and in market cap too. I think Gauntlet actually did a report a little while back on the fact that Ampleforth is on the sort of the Ampleforth network, and one of the conclusions was that the Ampleforth token actually is uncorrelated. But putting that aside, the question is, why is the fact that it's uncorrelated important? I think there are various other assets that you could come up with, and this is sort of the pushback that I would give to the Ampleforth team, which is, you could come up with various different kinds of stable coins or even just tokens that have different movement patterns that are uncorrelated. You could have some sort of lottery based token that basically just changes its supply based on some sort of random number generator, and that sort of new supply goes to some random holder, and that would be uncorrelated. I mean, this is kind of like a silly sort of thought experiment, but
I think you're exactly right.
Yeah.
I think just uncorrelated in and of itself is not
exactly. So I think essentially the value in an Ampleforth token and the sort of aspirational value that it has is to sort of move towards the stability. And whether I think ultimately the value is to become some sort of stable base money. They don't call it a stable coin, but I think that's the sort of the goal of the token. And I think that's sort of the value proposition that's there. And then sort of the question becomes, well, can it actually ever achieve that? And I think this is where we get into a really important distinction between Ampleforth and other algorithmic stablecoins, which is that Ampleforth, because of the way that it rebases the entire network supply as opposed to just the stablecoin component. And so this is, again, getting a little bit far afield, but these other algorithmic stablecoin networks have multi-token systems. So they have the stablecoin itself, and then they have these sort of seigniorage shares models where the people who hold these seigniorage shares tokens essentially are entitled to claiming the new supply that's minted in terms of the inflationary supply when the algorithmic stablecoin itself is trading above the peg. And then they have these coupon or bond tokens that can be used to essentially have future claim on the stablecoin when the token gets out of contraction. So you buy these coupons or bonds when the stablecoin itself is trading below $1, and then that buying mechanism essentially burns when you buy a coupon or a bond, for example, in basis cash or an empty set dollar. That burns, or it takes out of circulation the algorithmic stablecoin itself, which is supposed to contract the supply, and then the coupon or bond holders have claims on future either ESD, empty set dollar, or basis cash once the protocol starts trading back above $1. So that's a little bit of a tangent, but it's important to understand that essentially if you hold basis cash or empty set dollar or some of these other algorithmic stablecoin designs, the stablecoin, you don't have a claim to new inflation that is created, but you also don't bleed supply when the stablecoin itself is trading under the peg. So if I hold basis cash and now it's trading at, let's say, 90 cents on the dollar instead of $1, personally, I don't lose any tokens as a basis cash holder. Whereas in Ampleforth, I actually do bleed tokens. So Ample holders, every single day that the token is trading under $1, essentially bleed tokens. They lose tokens to the network. And so they're almost acting as this sort of central bank. They are sort of, Ample holders are going into debt for the sake of the network when the network is sort of in contraction. And I guess to summarize this sort of point, this difference, I would say that there's this crucial difference between Ampleforth and these other algorithmic stablecoins like basis cash, empty set dollar, and then of course the forks, which is that Ample actually might stabilize the price per Ample, but doesn't stabilize the purchasing power per Ample, because as an Ample holder, your current holdings is always fluctuating based on demand. So that, which is to say that if the price per Ample is at $1.10, you're not only changing that's not only changing sort of the purchasing power because of the price change, it's also changing the purchasing power of your wallet of Amples because that wallet supply is fluctuating. And that's different though for basis cash and for empty set dollar. Whereas if you just hold basis cash or empty set dollar in your wallet, you aren't gaining or losing token. So the only changes that are happening is based on price, and that creates a much, I think, more stable sort of apparatus that can stabilize the purchasing power of your wallet. Whereas for Ampleforth, any Ample holder is essentially susceptible to large demand shocks one way or the other, or large changes in demand.
So then moving off of Ampleforth and looking at empty set dollar, and they were actually a guest last week.
Yeah.
It's currently trading at about 64 cents.
Mm-hmm. Yeah. So it is, and so it's the empty set dollar network is currently in contraction, which is to say that, as you said, the price per ESD is at 62 cents on the dollar. So right now there are no new tokens that are created because it's obviously not an expansion, and the way it will currently get back to $1 is if people buy empty set dollar tokens, the ESD, and they burn those for coupons. And as I said, coupons or bonds in the basis cash system essentially entitle you to future ESD or basis cash. And I guess if we want to stick with ESD to not confuse the listeners, let's say if you buy an empty set dollar coupon right now, you can buy it sort of at a discount, and you can buy, let's say, I don't actually remember what the current premium for ESD is. I think it might have been maxed out, but you can buy sort of an ESD coupon for, let's say, 50 cents on the dollar. And then once the price per ESD goes back above $1, you can then redeem those coupons for, let's say, $1. So there is potential reward if you buy coupons now, which takes ESD out of circulation. And then assuming that enough people buy coupons, or the price or demand sort of comes back for empty set dollar, once the network goes above contraction, those coupons will be redeemed, and you'll sort of, the coupon buyers will sort of see positive returns on their coupon purchases. Now, of course, there's a real risk here for buying coupons right now in the current system, which is that these coupons might expire, and that's something that there's been a lot of talk about for changing. And there's actually a proposal right now to actually only expire the yield on coupons, as meaning this like extra premium, as opposed to the principal for buying the coupon. So that principal might never expire. But there's a real risk for coupon holders and coupon buyers, which is that their coupons expire after 30 days, and they can expire worthless if they're not able to redeem them. And again, they're only able to redeem if the protocol goes out of contraction back above into $1 territory and above. So this is a real problem, I think, and we're starting to see the pain of not only, we've already seen, people have seen the pain of Ampleforth and the problems with sort of these large contractionary and expansionary cycles, which is spread across the entire network, and sort of no Ampleforth holder is insulated from those market dynamics. But now we're starting to see those problems, I think, with empty set dollar basis cash was also trading below $1 for a while. Dynamic set dollar, which is an empty set dollar fork, has been trading below $1 for a while. And we're starting to see that some of the problems that exist with purely algorithmic stablecoins, which is essentially, to put it very, very frankly, these rely on speculative demand, essentially, to bootstrap the protocol. There aren't that many integrations that currently exist for these algorithmic stablecoins. They aren't really used as collateral for the most part in the crypto economic systems of other protocols. They might be starting to be used more, but right now, a lot of the demand for empty set dollar, for dynamic set dollar, for basis cash is all speculative. And especially with empty set dollar, which had this sort of very large expansion in dynamic set dollar as well, a lot of that speculation was sort of absorbed by the protocol. And now holders of empty set dollar are feeling the pain because the network is in contraction. And the only way to get back out of that is to see new demand come into the protocol. And so I think this gets to sort of one of the sort of fundamental problem with any purely algorithmic stablecoin, which is that it relies on speculative demand, especially when the network is in contraction. And that's true of Ampleforth. Ampleforth can go into a death spiral if it's trading below $1, and not enough new buyers want to come in to help bring it back to $1. And that's also true of empty set dollar and basis cash. It's essentially, as Hasib Qureshi put it in his article a couple years ago, these protocols are only collateralized by future belief in the system, which is to say, in a sense, they're not collateralized at all. So that's very
like the US dollar.
Yeah, I mean, it's a Schelling point. It's this idea that there's a game theoretic point that the market's going to converge to, and there's all this game theory that goes into it about whether or not there's enough demand that's flowing in, and demand that flows in has its own reflexive effect. So if people
can you give the kind of the just I'm sorry, because I think the Schelling point for some people might be a little bit beyond, but I think it's an important point. You give kind of what classic Schelling point example, if you're familiar with it.
Yeah, so I think the classic Schelling point example is it comes from game theory, if I'm not mistaken. I haven't studied the origins of this theory, but it's this idea that sort of there is a convergence through sort of self-interest and market dynamics, and that point of convergence is sort of purely determined by people's sort of self-interest in the market and these market dynamics. And there's I'm sure more concrete examples of how this.
Yeah, I was just the classic Schelling point example that I've heard given multiple times is if you tell somebody that you're going to meet them in New York City, but don't tell them where you're going to meet them, most people go to the ticket to the center of Grand Central.
Right.
There's an information point there, and that's kind of the Schelling point. If you don't know anything other than you're optimizing for yourself and meeting somebody, you meet there.
Yes. Yeah. I think that's a good a good real world example of it. It's this sort of in game theory, it's very similar to sort of Nash Equilibrium, which is this sort of very simple idea in the prisoner's dilemma of what happens when you have sort of two prisoners and they have very different incentives, or they sort of can cooperate together if they're communicating and basically both get out of prison, or one of them can sell the other out and basically get a better plea deal. And this idea of game theory, Nash's equilibrium, was that, well, they're actually both going to have the incentive to defect, to basically sell the other out, and that's going to reach this sort of non-cooperative equilibrium, which is a little bit different from a Schelling point, which is more has to do with
which is bad for everybody,
right? Which is worse, for example, than the cooperative equilibrium.
So in the spirit of time, and this has been fascinating, but in the spirit of time, because I know you wanted to also touch on Frax.
Yeah, of course. So I think this is like a really nice transition into it, which is what we just were saying about what I was just, my thesis about algorithmic stablecoins, which is that they are purely at the whim of the speculative market right now, as in any of them can fail. So I think Basis Cash and Empty Dollar have these extra guardrails, for example, but they can still fail if there isn't enough speculative demand. And this is where we get into the need for partially collateralized protocol for algorithmic stablecoins, because these partially collateralized protocols, and Frax is, I think, the best working example right now. ESD is working on a new V2, which is going to be partially collateralized, or at least looks like it's going to be partially collateralized. And these provide sort of a backstop of literally collateral in the system that prevents these protocols from fully going through a death spiral. And so the way Frax works, which is a little bit different from the way these other algorithmic stablecoins works, and you've had Sam on the show in the past, so I'm not going to go through an entire.
No, but please, Deb, if you can just give a quick overview, because sure. My guess is a lot of people who are going to be on this call or listening to the replay are not familiar with it.
Sure, of course. So let me give a brief overview. So Frax works essentially at bottom by a minting and redeeming mechanism. And so in this sense, it's actually more similar to the stable coins that I discussed earlier in the show, like DAI and Synthetics US dollar. The way Frax works is Frax has right now actually only two tokens in the network. There's the Frax stablecoin, and then there is Frax shares, which is similar to the senior shares component of Basis Cash and similar to bonded ESD. But the way that Frax works is essentially any user that wants to own Frax can either buy it on the open market or they can mint it by putting down essentially $1 of collateral into the system. And so let's say that I want to buy Frax. What I can do is I can buy it on Uniswap, or I can go to the Frax network, the Frax app, and put down $1 of collateral and in return get a Frax token, or do however many dollars I want. And now here's the sort of where the Frax sort of, I think, innovation comes in, which is that $1 of collateral that you put into the system is made up of a mix of both USDC or any kind of, that collateral can be changed to any other crypto collateral, but right now it's USDC. So part of it's USDC and part of it is Frax shares, which is this second token in the network. So depending on the collateral ratio, the collateralization ratio in the system, I might have to basically put down 90 cents worth of USDC and 10 cents of Frax shares in order to mint Frax. And then when I want to redeem my Frax, I will actually get out 90 cents of USDC or 10 cents of Frax shares. But what I can do is I can always be minting and redeeming for Frax. So Frax in that sense, and also what that means is that if you buy and sell Frax in the open market and the peg sort of gets out of whack and it goes to $1.05 or $1.10, you can have arbitrageurs come in and they can put their own collateral into the system, mint Frax for $1, and then sell that back down. So it creates this very nice market dynamic where the peg is being kept by arbitrageurs who are minting and redeeming. And this collateralization ratio is really the key here, because the way it works is that essentially the collateralization ratio is dynamic. It changes every hour potentially based on demand for Frax, demand for the Frax stablecoin, which is to say that if there's very little demand for the Frax stablecoin, that signifies that the market is actually not as confident in the network's health. And so that means that the Frax collateralization ratio will increase. It will start becoming more collateralized. So to mint Frax, you need to actually put down more USDC than Frax shares in the system. And what that means is that Frax can be fully collateralized by USDC if it's trading below $1 for enough time, or if there's a lot of belief in the Frax network and the Frax token, there's a lot of demand for it, and the Frax token is trading above $1, the Frax collateralization ratio can go down towards 0, which means that you actually have to put more Frax shares in as collateral down into the system. And what that does is the more Frax shares that are put into the Frax network, that makes it less collateralized by USDC, which means that it's sort of less backed. It's more algorithmic, because again, the Frax shares token is a sort of free floating token that is not that is not collateralized. It has no price peg. It's a speculative token, similar to the way that basis cash shares is speculative. So when you put Frax shares into the network, you're actually burning Frax shares, and you're also making the network itself, as in the Frax token, more algorithmic. It's less collateralized. And so this dynamic collateralization ratio essentially determines how algorithmic the Frax network is. I don't know if that's a great way of explaining it, but essentially the sort of TLDR is that when Frax is trading above $1 for a long time, the network will respond by making the token very algorithmic, and it will make it very speculative because it will be fully collateralized by FXS, the Frax share token. But when Frax goes below $1 for a little while, the network ends up becoming more like DAI, except it's not over collateralized, because it becomes, the Frax ends up becoming fully collateralized by USDC. And the more important point, overarching point, is that because of this minting and redeeming mechanism and the arbitrage that it allows for, the Frax token will be basically trading within this very, very tight band around $1. And as we've seen so far, that's what it's been doing. And it's very different from these other algorithmic stablecoins that don't really have a peg or minting redeeming mechanism, that sort of free float based on supply and demand. So that's I think how I would describe Frax, and I'm sure Sam would describe it much more eloquently. But that's sort of the overview of the network as I see it.
Okay, look, this has been great. Ben, thanks so much. And Sudhu, thanks so much. And we're going to go to questions from the audience. And let's see, we're going to take the first question from Sherry. Hold on a minute. I've got to take back control so I can bring them up on stage. So I got to reclaim host, and then I can make them guests on. And the first question is gonna be, that'll promote to panelists, will be from Sherry. So Sherry, welcome to Stablecoins Are Killing It. I think you might be on mute because we can't hear you.
Hey.
All right.
Didn't want to be on video.
we can hear you now. Your video's not on.
All right. Ben, where do you think Frax will be in terms of percent of collateralization ratio in like 1, 5, 20 years if it's successful?
So I think that's a great question. And no one knows. And this is part of the beauty of the Frax protocol, which is that it's agnostic as to where the collateralization ratio is going to end up going. I think ultimately we're going to see a lot of fluctuation in the collateralization ratio, meaning I think right now it's still, I think, well above 80%, for example, but eventually that might actually keep going down, assuming there's more sort of market belief in it. Will we go down ever to a full, like a 0, 10, 20% collateralization ratio and stay there? I actually don't think so. I don't think the market is going to have an appetite for a purely algorithmic stablecoin that's only backed by Frax shares. I think most likely we're going to settle around like a 30, 40, 50% collateralization ratio, which means like heavily algorithmic, but also very heavily collateralized. I don't think, but this is all speculative. For example, I think you could see network effects of, as Frax grows, people think that, because it can be collateralized in the future, they're okay with it being uncollateralized now, and that might allow it to get to a very, very low collateralization ratio. I think for it to get below 50%, it's going to have to grow a lot. We're actually already see over 100 million. The current circulating supply of Frax itself is over 100 million. I think for it to get below 50%, to stay below 50%, it's going to need to get to DAI's sort of level of basically circulating supply, which is well over 1 billion. And so to answer your question, I think that's sort of the answer, which is the beauty is that it's sort of agnostic as to where it's going to be. I do think that it's not going to settle at 0. I also don't think it's going to settle at 100. I think most likely it's going to be floating around 30, 40, 50%, assuming it's successful. Okay,
did that answer your question, Sherry?
Yes, thank you.
Okay, terrific. Thanks for the question. And let me, I just want to add on to that for a sec, because so I've been crypto 24/7 for more than 3.5 years now, and I will say, and my mind's been blown so many times from things that I've seen that just were incomprehensible. But the for me, the biggest mind blowing, like, oh my God, like revelation about how the world works is when it came out that Tether was only theoretically 70% collateralized, not 100% collateralized. And, and the price started crashing for a few hours. And, at the end of, I don't know whether it was 5 hours or 10 hours, it was back to $1 and nobody cared. And here it is, I don't know, a year and a half later after that happened, and it's at $1. So nobody cares whether it's 70% collateralized or 100% collateralized. I'd love to hear your guys' view on that.
Yeah, just to say something there, Lou. I mean, I think what's interesting is, as Ben mentioned, you're really, you're buying the kind of future trust in these coins, and this is the issue I have with algorithmic coins, which obviously they're very early, but there's a craze going on with ESD and DSD, but I think the real proof is either are they being used in sort of commerce or can they be, and obviously they are not being used at all. And then I guess the secondary question is, which is Ben's world more than mine, but is around, what I think is really interesting is that in the DeFi world of kind of mining and farms and pools, you don't find any of this. And instead of, this hatred for sort of centralized coins like USDC and USDT, you find dominate the DeFi space. And, everyone who says they hate centralization has no issues accepting centralized coins into their pools. Now, DAI is obviously very successful, but it's extremely collateral intensive to use. So I just, for me, it's, and it's a question for Ben as well. I think from, as being a non kind of DeFi or algorithmic expert, if we start seeing adoption of this in some way greater than it is right now, I'll be somewhat more comfortable about trying it out myself.
Yeah, I mean, I totally agree. Most of right now, even we actually, as I said, we aren't even seeing a lot of these tokens being used as collateral even within DeFi, let alone being used to transact, and being held in wallets outside of DeFi, which is sort of why I think ultimately, as you said, I think a model that relies on speculative demand and sort of bootstrapping a network through that can grow very fast, but it's not going to be sustainable in the long term. I think there needs to be, it might actually eventually get there after there's enough market belief in it, but it's like this, we can go back to sort of this Schelling point and this idea that, what are the incentives that people have under absence of communication and under absence of coordination. The problem with these tokens is that you can get rich on them, which is great for early adopters, but you can also get poor on them. And I think just to sort of talk about like usage outside of just the speculative demand and the speculative appetite of the market, I think one big benefit, and this is ESD and Basis Cash's innovation, is that with Ampleforth, you need to write very unique smart contracts that can deal with rebasing tokens, because Ampleforth, the entire supply changes. Whereas with ESD, Basis Cash, and Frax also, none of these tokens themselves change sort of algorithmically in the sense that every wallet doesn't change. So that's actually already an improvement in terms of composability in DeFi. I wanted to bring up one actually problem to talk about in the article that I think would be interesting to Lou and Sudhu. I'm curious to hear your thoughts about. I've talked to a couple friends of mine, one of whom actually wrote an article on this a couple years back. His name is Richard Chen, and he compared the.
Who's Richard with?
Richard is a partner at One Confirmation in San Francisco, and
crypto VCs.
Yeah, he's a crypto VC, and so he and I have gone back and forth on this, and he pointed out to me that, if you look at some of the problems with algorithmic stablecoins, it's actually that because they're so speculative, it renders them vulnerable to Soros-like shorting attacks. And just to sort of explain briefly what that means, in the 1990s, I think it was 92, basically Soros took out this massive short position. He borrowed a ton of British pounds, but when he saw that there was downward pressure on the pound, and he basically saw that he could essentially have this asymmetric trade in terms of risk by borrowing a ton, selling them on the market, and putting downward pressure on the pound, and he succeeded. And essentially, the British government ended up breaking the peg with the German mark, and Soros made a windfall in a day, like maybe $1 billion. I think there's a lot of different things.
I mean, just to be clear, because right, I'm sure you're aware Soros is a catchword,
right?
For a lot of not good things.
Right.
But I mean, what Soros was doing was just taking advantage of the fact that the central bank was propping up its currency and trying to get it to a value that it should not have had. Exactly. And he was just forcing it back to the value that it should have.
Exactly.
That the market would give it.
And there's actually pretty good economic theory behind it. It's called the impossible trilemma, which basically states that you can't have sort of the fixed exchange rate that the British government wanted to have, plus the free flow of capital, and at the same time, and sort of, you know, the British government was, the currency was essentially losing its peg, and Soros bet on that, and it was totally legal and totally kosher for him to do that. And I think, but I think, you know, what's the corollary here with algorithmic stablecoins? I think the corollary is that because these are bootstrapped by speculative demand in purely efficient capital markets where you have a lot of lending and borrowing going on, you could theoretically have a case where, you know, a borrower essentially wants to borrow a ton of ESD or a ton of DSD or a ton of basis cash or a ton of Ampleforth, sell it on the market to try to crash the price, you know, basically perform a Soros-like attack, and, you know, with somewhat minimal risk. If you sell a lot of ESD, for example, when it's above $1, you're betting that it's eventually going to go back to $1, but it's not the same kind of risk that when you short something like Bitcoin, that it could, you know, double or triple or quadruple and just stay there. With ESD, there are these market dynamics that's going to push it back to $1. But then on the other hand, there's this asymmetric upside that it could potentially crash the entire network. And I don't think these are imminent risks because we don't have purely efficient capital markets right now. You know, there aren't large short positions on ESD or basis cash or Ampleforth. I mean, you can actually short, you can actually do that, I think, on FTX, Ampleforth, but especially with ESD, for example, those don't really exist. There are caps on lending and borrowing, but this is sort of gets the point of, you know, some of the problems with having a speculative token and some of the risk, the sort of attack vectors that exist. And, you know, we haven't even just talked about what happens to these algorithmic stablecoins in bear markets. Like, you know, will they exist? Will there be enough speculative demand? And this is ultimately just why I think we need, you know, this is to Sudhu's point, like we haven't seen, these are very early, we haven't seen them stress tested fully. But I think ultimately, you know, my thesis, and I want this for the sake of the health of these networks and also for the sake of, you know, the people who own them, I think they need to sort of move toward collateralization or partial collateralization mechanisms, or else they're not going to survive in the long term.
Okay, terrific. We got next question from Karen, who said that she doesn't want to come up on stage. So I'll ask a question for her, and it was from Sudhu, which was, you know, her question was, given the high interest rates that you're offering, what are the gating factors to faster growth, right? I mean, you would think in a capitalistic market, you know, you would be at, you know, billions of dollars given the interest rate that you're offering.
Yeah, I mean, it's a fantastic question. I mean, firstly, just to reiterate, these are not high interest rates that CoinFLEX are offering. These are actually interest rates that are naturally occurring in crypto derivatives and in specifically the difference between the futures prices and spot prices. And so it's not a CoinFLEX airdrop. This is essentially real dollars floating around in the derivatives markets. And as such, literally the gating factor to faster growth is the growth of derivatives compared to the growth of the stablecoin market. Right now, stablecoins are 30 billion plus. Derivatives open interest is a smaller component of it, around 18 billion. And so there's this kind of huge rate difference that this mismatch of dollar borrowers and lenders create from trading. Of course, you know, if you take an extreme example and say there's $300 billion of stablecoins and only $50 billion of derivatives open interest, then of course these rates will start coming down because there will be a huge supply of dollars into the system. And so trading firms around the world will fight over themselves to kind of push these curves down to make returns. But you know, the key thing here is that there will still be returns of some sort. It may be 2% or 3% or 4% rather than 5 to 15, but the point is that these rates still exist because we've seen them in time immemorial from the traditional space, and you know, whatever rates you get on Flex USD and these repo based stable coins, they're always either, the worst case is it'll be zero for an 8-hour period, which is exactly what you get right now from USDC or USDT. So
yeah, which is better than you get from a lot of banks.
Correct.
And, you know, so, but do you have any insight into, you know, of the $30 million that's been minted to date, who's minted it?
Yeah, it's a wide variety of people, actually. There's been sort of family offices, retail, and some whales as well testing it out. The really interesting inquiries we've been getting recently, which I think bodes well for this space, for crypto generally, is that we've been approached by a lot of family offices who are essentially have no exposure to crypto, they are very, very uncertain about Bitcoin and Ethereum and other coins.
Where located in any
in Asia, sorry, in Asia. They're kind of very kind of suspicious of crypto volatility, crypto prices, but they're very, very attracted to the dollar yield that comes from stable coins. And so what is really exciting about what's going on right now is that I think stable coins are the crossing point for traditional kind of people looking at the edges of crypto, whilst they kind of view Bitcoin and Ethereum and other coins at a kind of later date. And of course, they call stable coins crypto, whereas obviously for us, it's about boring as hell, which is, we call it cash. So it's but it's, if it acts as a bridge for adoption from the traditional space into our world, it'll be great.
And Ben, were you at all familiar with CoinFLEX before?
No, I hadn't heard of it, but I'm gonna do some more research into it after this call. I'm pretty interested, Sudhu, and I'll be following up with some questions. And I think, just to mirror what you're saying, I think like stable coins, whether they're going to be algorithmic, whether they're going to be sort of centrally minted or permissioned, they're doing a lot of good. Bitcoin's very important, but people need US dollars in places in the world where they don't even have stable currencies. And I think there's sort of this interesting gradient among sort of US citizens who are very worried about inflation of the US dollar. So the US dollar might not be good enough for them. And obviously there's not really consumer price inflation right now, but there are other people around the world who, as Sudhu said, they're not even getting yield on their stablecoin. So that's just an extra bonus. But even just, don't have access to stablecoins. And I think there's actually been some interesting studies that show that a lot of the USDT that was minted was actually sent to places like Venezuela and other countries that are sort of inflation racked. And so I think that's sort of the stablecoins plugging into this sort of emerging euro dollar system and sort of these swap lines that are emerging across the world and sort of becoming a permissionless sort of solution to that. That's going to help a lot of people, even if the US dollar eventually doesn't survive in the way that it currently does.
Okay, this is the second to last question I'm going to ask you because we're coming back to the top of the hour. But can you guys share your opinions on CBDCs and the impact you think they'll have on the market? And Sudhu, you want to start?
Yeah, I mean, obviously, it's we're right next door to probably one of the biggest experiments in this in China, and it's kind of weird, as far as we can understand it, at least in China, like, WeChat Pay is is an electronic form of payment. And so this whole CBD concept has gone down very, very poorly because everyone's just like, well, we already use our phones to transfer money, to pay for things seamlessly. And so why have a digital coin on top of that when the one is already digitized through WeChat? And so adoption has been very, very poor in China. But absolutely, as Ben said, there are plenty of other countries where the benefits of this for inflationary reasons or bank account or access to finance, where it could have a huge influence. But we haven't seen it in China. I mean, in fact, they're airdropping it as promotions to get people to adopt it, which is just ridiculous.
Yeah, I think that's a great one great summary. I think a couple things to add are that I have some worries in terms of some of the countries that are doing it. I think it'll give them more control over surveillance in terms of people's money. I think it's going to give the government a lot more control, especially when it comes to, I think we're going to see CBDCs.
But more surveillance, and how is it more surveillance in WeChat or WeChat, WePay or Alipay?
Well, there may not be more surveillance than WeChat and Alipay, except for also this might allow governments to claw back currency without even any kind of
like they do USDC or Tether.
Yeah, exactly. I mean, right. So if I mean, I think this is going to allow for more maybe tweaking of monetary policy in ways that, I don't know, could be beneficial or could not be. I think we're going to see the emergence of CBDCs accompanied by some sort of modern monetary theory that basically allows. I think what a lot of the reason why these central banks are looking to experiment with CBDCs is that they need more tools in their toolbox in order to sort of put more money into the actual economy through these monetary levers and vehicles. I guess one thing I would say though, which is interesting to me, is that I think, with the recent news with Circle, and I'm speaking now just about America and American CBDCs, I'm not as familiar with what's happening. I mean, I know there's some interesting developments in China, and then, in the Euro central bank basically recently has said that they're also looking to do that, although maybe on a slower time frame. But with America specifically, it's really interesting that we recently saw as much of a sort of public endorsement from the OCC of Circle and of USDC that can now be used for banks. And just even yesterday, the OCC conditionally approved Anchorage, which is to be like a digital bank. And so it's going to be a question to me whether the Fed even needs to create its own CBDC, or whether they can basically just plug into Circle. I don't know exactly how composable those things will be. I think that remains to be seen, and I think that's going to have drastic.
The Fed has said that they won't be composable. The Fed has said they will not allow smart contracts to go on top of
Right.
A CB. I mean, again, it's very early days, and they could change that.
Right.
But that's one of the most striking things, just in terms of the few times I've listened to the Fed talk.
Right. That's true, but I guess with banks that are going to be accepting USDC, loaning out USDC that you can use for payments, that you don't have to use Swift anymore and stuff like that, it's going to be a question as to whether, I think in the US, if that kind of continued adoption for Circle continues gaining traction, whether whether the Fed CBDC will even take that much market share from currently existing stablecoins. And I think there's going to be probably easy ways to get between them, even if they're as you said, like the US, even if the US isn't going to put the CBDC on Ethereum, there's probably going to be custodians that can be exchanging them and wrapping them one for the other.
Wrapping will be interesting, right? Do they let it be wrapped? Unfortunately, we're at the top of the hour. This has been awesome. Thank you guys so much. And I will just add, on top of CBDCs, I think it's the primary use of CBDCs, and this is just purely conjecture, obviously, is for outside of China. It's the de-dollarization of the planet. I don't know if you guys are familiar with belts and roads, but they're investing around the world in infrastructure, and my guess is they're going to at some point flip a switch and start to do all that investment through their CBDC. Why wouldn't they? And then start having it go around the world. And would you rather use Swift or would you rather use whatever rails China sets up for its CBDC? And I'll bet you a lot of the world would rather have the latter.
Yeah.
And the last question, thanks both of you. If somebody wants to get in touch with you, if somebody, what do you want to leave people with about your project and yourself if they want to get involved? Sudhu?
Yeah, please reach out at contact@coinflex.com or on Telegram, which is @Sudhu_coinflex, and happy to help.
Thanks.
You can find me on Twitter at BenjaminSimon97. Also, my fund is Mechanism Capital. You can follow us, and my DMs are open. So I'm sure there was a little bit. I've tried to pack in a lot of information on algo stablecoins, and so if you have questions, just send me a message. My DMs are open.
Awesome. This was great. Thanks, guys. Thanks everybody for showing up.
Thanks, Lou.
Thanks for having us.
See you next week. Coins are killing it. Number 27.